This is Bloomberg.
If in doubt, blame Target. You did that 3 weeks ago. You can do it again this morning to a certain degree. Equity futures are down by 0.9% on the S&P. On the Nasdaq 100, down a little more than 1 full percentage point. Target is going to be a whole lot lower at the opening bell. Maybe just not as low as it was 3 weeks ago. Another cut to the profit outlook. Switch at the board. There's your opening bell in the bond market. We look a little something like this. Yields lower by 3 or 4 basis points on a 10-year. Still just about holding on to 3% on a 10-year. In the FX market, euro dollar 1.0 and all the sixes out of the ECB on Thursday for President Lagarde. New York crude WTI 118.22. We are negative 0.2% with a big call coming from Goldman to have a little look at 140 later in the third quarter. Big headline crossing the Bloomberg too. Let's get to Mike McKee for a report from the World Bank. Morning, Mike.
Morning, John. Well, speaking of cutting, the World Bank cutting its global growth forecast. This would be a man bites dog or dog bites man headline, except that it's more gloomy than we anticipated. 2.9% is their forecast now for global growth. There's no accepted definition of what a global recession is, but as they say, that's close enough for government work, 2.9%. And they give us a stark warning that stagflation is on its way, low growth, and high inflation will be around for a couple of years. Talk more about all the details in just a few moments, John, but a gloomy outlook from the World Bank.
Hey, Mike, looking forward to it because we'll catch up with David Malpass, the World Bank president, in around about 10 or 15 minutes' time. Mike McKee, thank you. One stock to look at, it's Target. We're down about 7.4% in early trading. Let's get to Abby for more. Morning, Abby.
Good morning, John. Yes, we have Target plunging down more than 7%. Right now, the stock at its lowest level since September of 2020. And this, of course, after the company slashes its profit outlook and its operating margins for the second quarter. Once again, the second time in 3 weeks. It's like Groundhog's Day. So Target down about 7%, weighing on the other retailers. Walmart, Macy's, and Wayfair all down sharply too, as it's a fear that it could be not just a Target problem, that inventories are bloated at a number of retailers and as folks spend more money on experiences. And of course, relative to those operating margins, the company now looking for a 2% operating margin in the second quarter. That is the current quarter. The average analyst closer to 6.6%. Now, they do expect a little bit of a recovery later this year toward a 6% operating margin. They also expect the fiscal year revenue growth to stay in the low to mid single digit range. So a bit of a mixed picture here. It really seems like a true operating problem as opposed to customers so much. But it's pretty clear, John, that if they slash the operating margin to 2%, they have the ability to discount in a big way to make the items look attractive. The stock, as we were just looking at, also on sale, down sharply, down more than 30% since its fiscal first quarter was reported. The question is, when will investors want to buy? That'll come down to the E in the PE when it stops falling.
I should point out again and repeatedly, we did this 3 weeks ago. We're doing it again this morning. Gabby, thank you. About 2 or 3 minutes into the session, this is what we look like. The S&P down 1%, energy outperforming up 0.2%, information technology together with consumer discretionary underperforming, IT down about 1.2%. Taylor Riggs, some of these big tech names facing a familiar problem. Higher yields, and that's the story of the last week.
Indeed. So today, of course, that story reverses. We're back below 3% on the 10-year, but you're totally right in terms of the long-term trend has been the path to yields higher. Ian Leon over at BMO Capital Markets yesterday saying that look for more cheapening, especially when we're getting some supply this week as well, particularly on the long end. So with yields higher and some of the cheapening, a bond price lower, that certainly means more volatility within the tech space. That's what you're seeing there, John. It was pretty incredible. We've gotten used to a lot of this volatility, but you've done now almost 3% swings from the peak of yesterday, big gains higher into some of the sort of losses today when we take a look at the NASDAQ 100. And the futures and sort of that intraday price action. If there is any good news out of this, it's sort of a re-evaluation of some of these valuations, how we're thinking about valuing these companies. As you can see there, we're actually sort of back to where we were pre-COVID. So sort of leading to a lot of people saying, have we taken a lot of the froth out of the market? Gina Martin Adams out of BI, huge note this morning, fair value on the S&P looks at around 4,100 or so. When you think about really sort of the forward PE ratios of all of these companies, John, as you mentioned, though, when we think about froth and sort of pulling out of this market, $3 trillion year to date has been wiped out so far this year. Take a look at this, and it's all the big companies, Apple, Microsoft, Amazon, just really seeing a lot of that market cap coming out.
Absolutely brutal. Taylor, awesome as always. Look out for Taylor's coverage at the close a little bit later with Romain and Caroline Hyde as the market close wraps up. The open just underway, a couple of minutes in, call it 4. And no real drama on Twitter this morning. We're down just 1/3 of 1% to 39.44 as Elon Musk is threatening to walk away from his $44 billion deal. Back with us. Let's get to Ed for a little bit more. Morning, Ed.
Yeah, morning, Ed. A more modest decline, but still the spread widening, right, between $54.20 offer price and the current share price. Interesting reporting on the Bloomberg terminal from Kurt Wagner. There's no such thing as buyer's remorse. We always say on this program, we don't know what's inside the head of Elon Musk, but we do know what Twitter's board thinks. They've said in the last 24 hours they intend to hold Elon Musk to the terms of the agreement reached on April 25th, which is $54.20 a share, valuing Twitter at $44 billion. That's a phenomenal deal when you take into account the sell-off in tech stocks we've seen this year. You just discussed that with Taylor. Another piece of reporting on the Bloomberg terminal overnight, John, the Texas Attorney General has opened an investigation into Twitter looking into whether they're misleading the public over the proportion of users on the platform that are bots. Interesting.
Ed, this is turning into a mess for both sides at the moment, that's for sure. Ed Ludlow, thank you, buddy. As always, that stock basically unchanged. Let's get to the bigger debate of the last couple of weeks. We've seen a squeeze in the stock market. We're off the lows. Is it a bear market rally or the start of a new bull phase? Strategists continuing to weigh in on the debate, with Strategas running the following. One of the more difficult calls in this business is differentiating between a bounce in a downward trend versus the start of something more durable. Our best guess remains the rally is more the former than the latter. Let's get to Kaylee for more. Hey, Kaylee.
Hey, John. Well, Chris Verone, who heads up technical analysis over there, is pointing to momentum as his reason why. He says typically when you see a significant market bottom, there's a lot more stocks trading above their 50-day moving average in the S&P 500. That usually that percentage number blows out to something in the realm of 80 to nearly 100%. We have not seen that yet. As of this moment, only about 41% of stocks in the S&P are actually trading above that technical level. So he says that raises doubts about whether this uptrend can actually last. Because yes, the S&P 500 has recovered some ground after narrowly avoiding falling into a bear market just a few weeks ago, but still the index is down more than 14% from its record high in the first couple of trading days of this year. And we know that there are plenty who think that this still has further to go. The loudest voice being Mike Wilson over at Morgan Stanley, who's warning about earnings, saying by the time we get through the second quarter earnings season, when we're in mid-August, this index could be down around 3,400. And Bank of America's Michael Hartnett also is in the camp that this is just a bear market rally, saying he would short the S&P above 4,400. Meanwhile, JP Morgan in the more bullish camp, saying the fundamental risk reward for equities is likely improving as we see peak Fed hawkishness and peak dollar strength. And overall, strategists are still leaning on the bullish side. The median year-end target for the S&P 500, 4,800, John, though it's worth noting there is a 35% spread between the lowest and highest targets. So that really just speaks to the division out there on the street right now, John.
Big time. Well illustrated. Kelly Lyons, thank you. Thank you very much. Here's the take from BlackRock. Here's the quote. Defensive positioning and capital preservation will dominate in the near term. A list of hurdles needs to be cleared before aggressively adding to risk, but mispriced companies are increasingly harder to ignore. Pleased to say that waiting patiently is Kate Moore of BlackRock. Kate, let's borrow that language from Strategas, that decision. Is it a bounce in a downtrend or the start of something more durable? Which one is it?
Yeah, I'm going to agree with Strategas, actually, John, and say it's pretty difficult to identify at this point. The one thing I'm really focused on, though, and this is where, figuring out exactly the direction over the next couple months becomes increasingly difficult, is that this lack of conviction across investors. We've had, as you mentioned just a moment ago, kind of weaker breadth. There seems to be across all of the investing segments, a lack of strong conviction in the direction of the market, going into September. Now, next year, I think people are going to be more optimistic, but we're not really fully pricing in 2023 at this point. So I think I'm not going to call it a buyer's strike, but I think we're going to see a lot more investors remain on the sidelines, remain cautiously positioned, and that actually may lead to some interesting opportunities for longer term investors.
Okay, let's talk about those opportunities. You've got three themes. I want to start with this one. It's timely. The consumer and the rotation from goods back to services. Is Target evidence of that happening right now?
Yeah, I mean, I think that's going to be a really interesting thing to watch, not just in Target, but across the entire competitive group there. I agree that everyone's extrapolating Target's experience to their peer group and then perhaps to the entire retail industry. You know, the silver lining of this, and I know this has been discussed a little this morning, might be that goods prices actually see some disinflationary pressure as a result. And that would be, on balance, pretty good for the consumer. But as we've talked about a lot, you know, we're seeing this rotation from goods consumption to experience and services spending. I think that is a very durable trend through the entire rest of 2022. And so maybe that's a little where I'm focused on the pricing side. I'm not worried about the health of the U.S. consumer. I think this rotation is clear and makes sense coming out of the pandemic. But we do want to be conscious of where the opportunities are from an earnings perspective. And if those retailers have bloated inventories and we're seeing this rotation in terms of spending, then I think we need to be thoughtful about where we're putting our money to work.
Okay, energy, another story for you as well. That's another favourable, durable trend you expect to persist because of what you say the supply-demand backdrop is going to support natural resources. The numbers out of Goldman, Kate, are unreal. 140, a 3-month price target on Brent. WTI, a 137, and even 12 months out, they're looking at 130 and 125 respectively. Do I want to play that still through the energy names, even after they've ripped as much as they have, Kate, this year?
Yeah, look, we firmly believe there's still upside in energy and resources. Of course, it's going to be volatile. Of course, we're going to see some bounces. And of course, the bear debate here is whether or not slower global growth will take some of the demand pressure off resources. But it's been the supply side that really led us into this investment to begin with. In the fund, we had started adding exposure to energy and resources over the course of 2021. Of course, we continued to add through the beginning and part of this year. And now energy and materials are significant overweights for us. Look, we think even in a slower economic growth environment, the supply discipline, both from sort of industrial metals and miners, as well as on the energy side, really supports elevated prices for the medium term. And many of these companies are trading at really discount valuations to the rest of the market. And I think we can still get significant upside from here.
Okay, the last one in your 3 themes. This is the one where I really need some help. You say the secular trend of digital spending and transformation across industries. Now, typically when people hear that, they'll be thinking some of these tech names that did well in the pandemic and they're really struggling now. What do you mean by this? Can we get some more detail on where to look for that theme?
Yeah, when I talk to people about technology and I say, hey, I still see a huge amount of potential upside over the medium term, you know, sometimes people say, well, what about these big mega caps that really outperformed the market over the course of the pandemic? Isn't their story over? And I say there's a lot more to technology enablement, and to this digital transformation outside of the top 4 or 5 names. In fact, it's more around software and enterprise spend. We've talked a lot about security software over the last year or two, that I think we're going to see very durable investment across all industries. So I would tell investors to take a look below the mega caps and take a really strong look at where demand and spending will be. And I think they'll find that, you know, even though multiples have come down, the revenue and growth story, you know, remains intact. You know, these are places that most CFOs, most CTOs, and most, you know, management teams will not cut their spending. These are kind of durable and resilient areas, I think. And so I think we have some interesting valuations and good long-term durable growth.
Kate, a clinic, as always. Wonderful to catch up. Kate Moore there of BlackRock, breaking down the 3 themes she's looking at. This is what we're looking at right now. About 13 minutes into the session, the equity market down 0.6% off the lows. Speaking of off the lows, Target now down about 5%. Just as the session grows older, things get a little bit better for that name after the second cut to the profit outlook in just 3 weeks. Coming up, the world feeling the effects of rising inflation and slowing growth.
Economic dislocations, whether it's a recession or just depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people.
That conversation up next with the World Bank President, David Malpass.
Economic dislocations, whether it's a recession or just depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people. When you talk about the consumer, you got to ask who's got the wherewithal to withstand a slow patch in the economy.
The World Bank has a warning. Here it is. Here's the quote from their latest report. The world economy is again in danger, facing high inflation and slow growth at the same time. Even if a global recession is averted, the pain of stagflation could persist for several years. Mike McKee joins us right now. Hey, Mike.
Good morning, John. Well, it is stagflation in the forecast from the World Bank. That is low growth, high inflation. They say it could last for years. They predict that global growth will just reach 2.9% this year, which, if you ask any international economist, comes very close to the idea of a global recession. Now, take a look at what's happening in individual countries. Almost all of the developed nations have seen their growth forecasts cut in half by the World Bank. The U.S. goes down to 2.5% from 5.7% coming into the year. China, 4.3%. Interesting question for David Malpass. With COVID still hanging around there, can they even make 4.3%?
Yeah.
Euro area cut in half. And here's the sad part. We've talked a lot about the destruction that Vladimir Putin has brought to the world economy, not just his own. And we've talked a lot about Russia, down 8.9% this year. The Ukrainian economy now forecast to contract 45% because of Russia's invasion.
Mike McKee, that is utterly depressing. Mike, thank you. Let's speak to the man himself, David Malpass, the president of the World Bank. David, fantastic to catch up with you, sir. Let's start with this. Mike touched on it. How would you define a global economic recession, and is this it?
Hi, Jonathan and Mike. This is many countries will have a hard time avoiding a recession. We're not in. It's not a global recession yet. It could. The downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years. That's from the 2021 rate, which was high because of the recovery from COVID, to what we're looking at now, 2.9% in 2022. That's a very sharp slowdown, and it's really hitting the poorer countries hard.
David, what's interesting about this report is there is a temporary attitude to the conversation on Wall Street. I have them every day. You listen to some of them, I'm sure. When we have these conversations, we talk about maybe lasting 6 months. You go into 2023, things change. The essence of this, or the epicenter of it, is a dynamic that lasts for years. David, this stagflationary story could last for years. Is that really the case for you? And over what regions? Is this a global story or more concentrated for emerging markets and developing economies?
It's global, but it particularly hits the developing countries. There's a lot of inequality in the world. So the advanced economies, and particularly the people at the top in the advanced economies, have done very well over the last decade. So the reason that this is a prolonged risk for the world is that we're coming off of a very exceptionally low period of interest rates. Last year I called it uncharted territory on both fiscal policy, which was massively expansionary, and the monetary policy. So we're coming off of that. And you also have demographics, which are gradually slowing down in the world. Fewer people coming into the labor force. And so that's part of it. And then this core problem of lack of supply and the supply chains not being repaired. One thing I'll add to this is energy is at the core of a lot of the supply. It's what makes fertilizer. It's what makes electricity. And there's as Russia is excluded from this, it means there's a big shortfall of energy, and it's not being made up for by new supply.
David, as you've pointed out and we've talked about, we're going to see a massive wealth transfer from the commodity importers to the commodity exporters. Within that, we're going to get some financial imbalances. Now, David, if I was doing this at the consumer level, if a consumer faced tough times, I'd be worried about a loan shark, if you will. Who is that loan shark on the international stage? And I know previously, in previous years, you've been worried about China and some of the loans they've made and the conditions around those loans that have been made to some of the economies that you focus on. Are you more worried about that now with this playing out?
China was the biggest lender during this expansion of the world, lending into countries, both poor and middle income countries. So one of the concerns right now is our data shows that it's 60% of the countries are either in debt distress now or at high risk of debt distress. That's for the 75 poorest countries, the IDA countries of the world. 60% are in debt distress, and with a big chunk of that debt owed to China. So we really need to find ways to restructure the debt and have it be more transparent. You know, the contracts have been written in recent years with collateral clauses, with non-disclosure clauses, and so the countries, it's hard to engage the conversation. So we've really worked with China to have them engage in the conversation to do the debt restructurings for the countries that need it. Right now, though, the distress is spreading to the middle-income countries. And I want to come back to the first point, Jonathan, that Sure. It's imperative that there be more supply in the world, especially of energy.
David, what's the likelihood of that happening anytime soon? Are these real suggestions that we can actually act on, or is it just a warning that this is what we're going to face now for a long time?
There are immense amounts of available, you know, natural gas is a key component of fertilizer and of electricity, cleaner energy for electricity generation, and it's available. It just needs to be announced, and the markets are forward-looking. So if you announced an intention to have more supply now, it would affect prices immediately, but we've seen that that's not happening. Oil prices are way up, I don't know, today, $119 a barrel, and so that's showing you that there haven't been announcements of supply, and I don't see that the governments are making steps on that. Canada did announce an ability to increase supply. I think Mexico and the U.S. could increase supply substantially, and Europe itself has energy reserves that they could be tapping, but so far it's not happening.
David, you took us to clean energy, so let's go there. The FT reported recently that the Treasury sent you a letter, sent the World Bank a letter asking you to increase your efforts to fight climate change and provide what they called more forceful and constructive leadership. Can you confirm that you received that letter, and can you talk to me about the content of it?
Yes, there was a letter. It was sent in March, so I don't know. The FT is digging deep into its reserves. They mentioned a UN criticism that was done way back in 2021. You know, there's lots going on in the world that I think would be a better focus. The U.S. government has been strongly supportive of the World Bank and what we're doing here. That comes out at every meeting, and it shows in the support from the appropriations process of the U.S., the bipartisan nature of the support for the World Bank. The reason is because we're doing a lot on climate, and I wish the FT would ask what you're doing and what others are doing, and recognize the World Bank has a strong focus on actually reducing greenhouse gas emissions by countries and having impact through careful spending. There's been this big movement in the world just to spend more money and not worry about whether it's having any impact, and greenwashing. We've worked to get away from that, and that's made some of the lobby. There's a big lobby for greenwashing, so they're not happy when you talk about impact, but we're going to keep doing it and keep making progress on cleaner energy. That means a lot more natural gas supply, and that's critical for future global growth because it holds down prices.
David, I'm trying to work out if you're more annoyed with the FT for publishing the piece or with the Treasury for sending the letter, but I haven't got time. David Malpass, great to catch up with you, sir. Thanks for joining us this morning. David Malpass there of the World Bank. Let's get to it in this equity market. Looking ahead to an ECB on Thursday, looking ahead to a CPI report on Friday, with an equity market looking a little something like this on the S&P 500. Equities lower by 0.4%. From New York City, this was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, June 7th. Here are the top market stories that we're following for you at this hour. Target turmoil. The stock falls 3%. The company cutting its profit outlook for the second time in 3 weeks on bloated inventories. It's not the economy, stupid, just stocks. Target's margin meltdown drags on equities while economic data and the consumer hold up. A Fed soft landing, though, can still spell pain for investors. And stagflation nations. The World Bank says the global economy is in danger from high inflation and slow growth for years to come. I'm Alex Steele in New York with my co-host in London, Guy Johnson. Welcome, everyone, to Bloomberg Markets. My takeaway so far is if you're going to want to shop on sale, you're going to need to go to all the major retailers. That's the takeaway. But we'll see how long that actually lasts.
Yeah, it depends what you're going to want to buy, though, isn't it? Basically, the problem here is the consumer taste is moving really quickly. As I heard somebody put it a little bit earlier on, not interested in swimsuits, but we are interested in suitcases. It's that kind of trade. It's that kind of nuance here. This is basically a misexecution issue at Target. The question is there a macro signal in here? And that, I think, is what we're all trying to figure out right now, Alex. Or is it simply that we've got a little bit of a problem with Target and maybe some of the other retailers because consumer tastes are changing really quickly. And once we get back to school, once things bounce back, we'll be back to business as normal. We will wait and see. But let's kick it around because I think it's relevant to where we are with the U.S. economy right now. So does a margin meltdown mean a stock crash? That is basically what we're asking here. Let's bring into the conversation Mike McKee, Bloomberg's international economics and policy correspondent. We've also got Poonam Goyal, senior analyst for U.S. retail at Bloomberg Intelligence. Poonam, let me ask you this question first of all. Is there a macro signal in Target's announcement today, or is this a one quarter, possibly 2 quarter problem that they're still working their way through there?
It seems more like a Target problem, not a macro problem. Keep in mind that Target just came 3 weeks ago along with other retailers that had all cited that there is an inventory glut. What's changed in the last 3 weeks is likely Target-specific internal execution and them having to clear out more than they expected.
When, though, Mike, might we know if it's more than just a Target-specific issue? Because we're still buying stuff. We're just changing what we're buying. And I'm wondering how long that part of it, that we're still buying stuff, stays for.
Yeah, it's been interesting. We expected a much bigger switch to services spending than goods, but that hasn't really happened yet. We're still buying a lot of goods, which would be good news for Target when you consider the inventory situation. Friday we'll get an interesting number, and that is the CPI for apparel. We've seen inventories rise significantly, and you can see in the last month, apparel prices started to turn down a little bit. If that's going to happen, that would be good news for consumers. But again, as Poonam would say, it may be just a Target thing, and it depends on what people want to buy within that category, as long as they're buying goods.
Absolutely. So what does this tell us about the consumer? Mike, where are we with the consumer? Some people tell me the consumer's in great shape, that we've still got a savings glut that we're going to spend. Look at what is happening with the airline story. People want to go out, they want to travel. Then I hear other people saying, well, this savings glut is being run down very quickly. The consumer's not worried about a recession, so it's comfortable doing that. Which is the right answer here? Where is the consumer? What's the right signal to take?
Well, somewhere in between seems to be the answer, Guy, because we are seeing savings run down. Last month they fell to 4.4% was the savings rate. It had been as high as the 8th. And so there's a little bit less money in the accounts, but right now so many people have jobs that they feel like they can keep spending. One interesting thing to watch for going forward is in the PPI, the Producer Price Index. We saw trade services, which is basically retailers, we saw prices go down in the last month, and that means margin compression. And so let's see if that continues when we get the PPI report next week.
Well, I think that raises the question, Poonam, is that how much more pain are these retailers going to feel? I mean, you see like Walmart in particular also down in sympathy with Target. Like, what changed in 3 weeks that they had to announce again?
Yeah, this is clearly an execution issue on their part because not much has changed in the last 3 weeks. We've known that there's been an inventory issue since February of this year is when e-commerce and retail companies started reporting. So it's really execution on their part. And, where I think there's a load of inventory that they need to clear is in the home and electronics space, categories that had flourished through the pandemic. So probably they got ahead of themselves and ordered more than they could actually sell through this year.
Poonam, what happened to the second half? The company's guiding us back up to around 6% in terms of the margin. Looks like we're going to bottom out around 2. Is 2 the bottom, and how hard is it going to be to get back to 6?
2 should be the bottom. I mean, coming around at it the second time in 3 weeks, you would expect 2 to be the bottom. Getting back to 6%, listen, if once they get the inventory out, if they clear it by the end of the second quarter, then getting back to 6 is reasonable. Keep in mind, they had 8% profit margins at the peak.
Right, and it's just still part of the unwinding of the stay-at-home trade versus reopening. That still feels like what we're in the middle of. Mike, then I wonder, and this gets to a piece that John Authers wrote in Bloomberg Opinion this morning, is that can you have something like a hard landing for the equity market and a soft landing for the economy? And it feels like Target is a really good example of something like that.
Well, we can define a hard landing for the economy as a recession. I'm not sure how you describe a hard landing for the stock market because it depends on your tolerance for losses. You get to a bear market down 20%, that seems pretty bad. It doesn't look like we're going to have any kind of equity crash, but we are going to see companies struggle for a while to work through the remaining problems that come out of the pandemic and the things that are getting thrown towards us because of the ongoing war and COVID. I mean, we don't know exactly what's going to happen with inventories going forward because China, again, shut down so much of their exports. So we could see some additional problems along these lines. And it's going to be hard to tell when we're out of this. And also the interesting question that I can't answer, Poonam made the point that people are switching back from buying a lot of electronics and home goods because the work from home thing has sort of been fulfilled. But what is fashion going to be like? What are people going to want to wear? Are we going to decide that we are all more casual because we work from home part of the time? And retailers are going to have to adjust to that as well.
Well, this is the point, isn't it, Poonam? We are in a very uncertain environment, and we talk about the execution risk that is showing up in Target. I'm assuming other management teams are facing similar problems here. How easy is it to predict consumer behavior right now? We are seeing a huge splurge of a summer. Everybody wants to travel. There's backups in weddings. There's all kinds of things that we all want to go and do. The cost of living squeeze in some ways hasn't really bitten. I know we've got gas prices up around $5 a barrel, but there is potentially more still to come. How easy is it to predict the consumer going forward from here? How easy is it to predict for these companies where they should be investing in inventory?
Yeah, it's never easy to predict where the consumer is going for retailers. Keep in mind, they have to make these predictions 3 to 6 months in advance most of the time. So most of what you're looking to sell in the summer has already been placed back last year, and it's coming to stores now. In terms of, where the consumer is shopping, what they're buying, they're going out more. They are going out, and we're seeing that with fashion. Fashion demand has picked up. If the inventory isn't available, stores like Rent the Runway are doing well because they have the opportunity to deliver fashion in a timely manner, and it's at a value, right? If consumers are feeling that they want to spend a little less because they have 10 weddings all of a sudden to go to versus maybe 1 or 2 historically, where's that money coming from? They can't buy 10 dresses. So are they renting? Are they buying used? They're shifting. They're shifting where and how they spend too.
Guy, to your point, though, Union Pacific also today said they weren't going to reach their profit goals for this year because of higher costs for fuel and network inefficiency. And Union Pacific is thought of one of those companies that are really good at managing those things, and they're also still getting hit.
Yeah, it just strikes it's a really tough environment, particularly as Poonam says, you've got to, if you're a retailer, order so far in advance. Now, some of those supply chains are coming in a little bit, but nevertheless, it is a huge challenge. This summer is an anomaly. This summer is not normal for the retailers. It's not normal for the airlines. It's really hard, I think, to predict where we're going to be in 6 months' time. If fuel prices in October, November, December are $4, $5, $6 a barrel, it is getting to the point in the UK where it is £100 to fill up an average car. Now, that's a really big deal. And as we work our way through the rest of this summer and work our way through this kind of pent-up exuberance, I think come the later part of this year, last part of this year, really difficult to predict how people are going to behave.
Yeah, that's some serious money. Hey, Mike, last question to you here. Final word. So, I mean, Guy was painting a pretty pessimistic picture of how much you have to pay for a gallon of gasoline, and I'm wondering, when are we actually going to understand what the consumer impact is?
Well, we're already starting to see a little bit of demand destruction for gasoline. And that's an interesting question, is how much more we see as the summer goes on, because as you're talking about, we're seeing a lot of demand by people to get out. They've been locked up for 2 years. But does that continue into the fall when gasoline prices start to fall? Or do people say, okay, we did our traveling and we pulled back? And one of the key things to watch is how much are people going to be spending this fall, because right now retailers have to start thinking about what they're going to order for the holiday season. So we'll be talking about this question come October, November, and whether they have enough inventory and whether they have the right things and whether they can get that inventory from China. This is a problem that's not going to go away.
Hey guys, thanks a lot. Really fun roundtable. Really appreciate your time. Bloomberg's Michael McKee and Poonam Goyal of Bloomberg Intelligence. Thank you both very much. All right, well, coming up, our next guest says that in a few months, we're going to get to a place where bad news is good news. Signs of a slowdown will ease the Fed to ease off those brakes. We're going to talk to the CIO of Kestra Holdings CIO, Karen Murphy. This is Bloomberg.
I think what we have here is a pretty powerful tension between drags that are not going away and a very resilient private sector, with the health of both households and corporates being quite remarkable right now. I think what we're going to see is growth continue to be on the softer side, but growth continue to show resilience. We don't see a near-term recession. We see a global economy which actually does okay in the second half of the year, with the U.S. slowing and the rest of the world doing somewhat better.
That was Bruce Kasman, J.P. Morgan chief economist, saying he doesn't see a near-term recession coming. So let's get back to our question of the day. Does a margin meltdown mean a crash landing for stocks? Well, Kara Murphy, Kestra Holdings CIO, joins us now. Kara, the question for you, and this is obviously based on what we're seeing with Target. What do you think?
So I'm going to take the other side of some of the comments that your earlier guest had, and where I think the kind of issues that Target is dealing with today are signs of a broader macro issue. So we are seeing supply chains ease, and those goods are starting to come through that supply chain and land on retailer shelves, just at a time when consumer demand is actually coming down. So that's led to this, start of an inventory glut, and it's high level of difficulty for various retailers to try and deal with this fast changing environment. But we're seeing on a macro level, supplier delivery times are declining, inventories are rising. All of this is happening really across the economy, and some retailers are better able to deal with it than others.
What's the signal then for the broader economy? Is the consumer struggling? Is this the early innings of the consumer struggling? What is the kind of, just go into a little bit more detail on the macro signals here.
So, we talked earlier about the very strong savings on the part of consumer, very, very strong labor market. Those savings rates are starting to be worked down. People are shifting their buying habits from goods to services. So all of that is sort of like the natural part of the cycle. But I think the key here, what's going to really change consumer buying habits is weakness in the labor market, which, by the way, we are starting to see. It's very early days, but more signs that we have that the labor market is starting to ease. That will really change consumer behavior and have them start to retrench a little bit in terms of spending.
So, Kara, if you were to put the odds of a Fed engineering a soft landing, what would the odds be? Because that kind of trickles down then into what kind of harder soft landing we may see, say, in the equity market.
For sure. Now, high level of difficulty, right?
Yeah.
But we still think it's better than even that the Fed engineers a soft landing. And all of the traditional indicators that we look at to tell us that a recession is coming are not yet sending a red flag. And so we do still think that this moderation in demand is going to be the theme for the second half of the year. It's been the theme for the first half as well. And we think that there's a lot of room, you're talking about corporate recession, there's a lot of room in company balance sheets and income statements to have softening, but still be able to continue providing growth.
So Kara, where does the stress come in terms of the profit and loss account? Presumably what you're signaling there is a top line slowdown as well as a margin squeeze. That is terrible for profitability. What is that going to mean in terms of earnings?
Yeah, so right now, we're still looking at about a 9% expected corporate earnings growth for 2022. I think those expectations do indeed come down. But I think the most important impact on a market level that we see are a continuing preference for companies with stronger balance sheets, more reliable cash flows. We've started to see the market, sell out of names that aren't making money, but we'll continue to have this rotation into the types of business models that can better withstand this type of volatility.
Yeah, but what's interesting is I would think that something like Union Pacific would fit that bill. They're also typically really good at being able to manage these kind of issues, and even they're having operational problems and inefficiencies.
Well, for sure, this is a very high level of difficulty. We've talked about this whole cycle starting with March of 2020 as being a cycle on steroids. Everything has been on fast forward. So even your really well-run companies that have been through tough cycles before are really struggling. But the question is this going to be a one-time, and is it going to be a persistent issue? And I think the better companies are going to be able to regroup and understand that we're in a new market environment and be able to react appropriately.
That new market environment, let's just talk about it. How do you see inflation evolving in the kind of scenario that you've painted?
So we think over the second half of the year, we'll continue to see moderation in inflation. On the good side, it's much easier to track that, right? So we can see goods coming through that supply chain pipeline, and they're starting to fill up, and that will bring down goods prices over time in the second half of the year. Services inflation is a lot harder, right? But that tends to be much more tightly linked to the labor market. So that's why we're following those indicators very closely. We're starting to see quit rates increase, again, just a little bit. It's early days, but they're starting to increase. We have labor force participation rates back to pre-COVID levels. Small businesses are saying they're not going to raise earnings anymore. So I think the more that we see those types of indicators, it bodes well for moderating services inflation in the second half of the year.
Okay, so Kara, based on that, if you are looking at companies that have, good quality balance sheets that can make profits, etc., where is that right now?
So on a broad level, we're looking at a rotation into value. So more value-oriented names, they have a little bit more cushion because they have lower valuations, expectations are a little bit lower, and you tend to have companies that have, more sort of defensible business models in rough economic environments.
In this kind of environment, how long does the US 10-year stay above 3%?
So we need to be, if we're right and inflation starts to moderate, growth starts to moderate, I don't know that 3-year bogey really stays for very long. If past experience holds, then that moderating inflation, moderating growth outlooks start to drop those long-term rates over time.
So does that mean that the Fed can't go as far as we think then? Or are we just going to be in a higher yet subdued new range for the 10-year?
I think the Fed, we're in this moderating environment because the market has already anticipated these rate increases by the Fed. So the Fed has to really continue to press on the brakes, and we think by the latter part of this, and by the fourth quarter of this year, as inflation and growth starts to moderate, that's when the Fed can kind of reevaluate. But they have to be aggressive until they get that. They have to earn their, the market's respect back that they can actually bring inflation under control.
It's going to be a bumpy and interesting second half of the year. Kara, thank you very much indeed for joining us. Kara Murphy, Kestra Holdings. Great stuff. Thank you. Okay, the U.S. Treasury Secretary Janet Yellen is currently testifying. She's doing so before the Senate Finance Committee. She's doing so on President Biden's 2023 budget. We will continue to monitor what is happening on Capitol Hill. We'll bring you the headlines. This is Bloomberg.
Access.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Shares at Target are falling. The discount retailer cut its profit outlook for the second time in 3 weeks. Target's trying to ease a surge in inventory by marking down more merchandise and canceling orders. Operating profit will fall to about 2% of sales in the current quarter. That is well below the 5.3% target estimated 3 weeks ago. And Kohl's is in exclusive talks with Franchise Group for a deal that would value the retail chain at about $8 billion. Franchise Group's offer is for $60 a share. That has Kohl's shares surging. In February, Kohl's said it had rejected takeover offers because they undervalued the company. And Citigroup will hire about 3,000 employees for its institutional business in Asia. The new staff will work in areas including investment, corporate and commercial banking. The bulk of them will work in Hong Kong and Singapore. There will also be new jobs in India, South Korea, China and Australia. And that is your latest Business Flash, Alex.
All right, thanks so much, Ritika. Treasury Secretary Janet Yellen speaking before the Senate Finance Committee. You're currently looking in there at Senator Wyden was starting the question. Janet Yellen just finished reading her prepared statement. A couple things we're going to be paying attention to. Yes, it's about the budget, but this comes on the heels of Janet Yellen's mea culpa on inflation that came out last week, plus confusion over what she actually said about President Biden's fiscal package, that pandemic relief package. There was a book that is coming out on empathy economics, and there's questions as to what she actually said in that book about her support for that aid.
Yeah, she's in a real difficult spot, isn't she? She's got a lot of history in terms of monetary policy. She's obviously got the fiscal policy mandate right now. I think there is a growing consensus that the economy didn't need all the stimulus. How that is going to be couched, how the mea culpas are going to develop, how the history books are going to tell the story, I think is going to be really interesting. At the time, a lot of people were very financially stressed. The US went down the model of not supporting people. It was helicopter money.
Yeah.
It was really difficult at one point to justify not providing people with that money. But it was as the story progressed and the exit became clear post the Pfizer news on the vaccine that I think the monetary policy and the fiscal policy, probably with hindsight, should have started to alter its trajectory.
Well, you have to wonder too, though, in part, the high inflation and the Fed tightening now, the consumer is able to manage it in part because of those pandemic checks that they just started cutting. The savings rates come down to 4.4%, but they had the cushion, and that's now helping them manage all of this. I don't know if that's good or bad. Like, do you want to destroy demand faster, or is the fact that the consumer is actually going to wind up being okay actually better? So I'm very interested to see it here, Guy, as we go forward, sort of the questions that she's going to get out of the Senate.
Yeah, but that's kind of chicken and egg argument, isn't it? Would we have had the high inflation that the checks would have been needed for if we wouldn't have had the checks in the first place? That's the bit that I can't figure out. Anyway, we'll get back. We'll talk more about Target next. Stocks under pressure. This is Bloomberg.
About that all day yesterday.
We're an hour into the U.S. trading session. You may not have expected what has unfolded when we got that Target news a few hours ago. We're now almost flat on the S&P. Bloomberg's Abigail Doolittle is tracking some of those moves. Abigail?
Yeah, Alex, it's almost a turnaround Tuesday, not in the traditional sense, but from that ugly open down more than 1%. The S&P 500, to Alex's point, basically flat at this point, down just fractionally after yesterday's gain. Let's see whether or not it can turn around. And of course, one help for stocks today, and especially the NASDAQ 100, those tech-heavy stocks, yields are in after backing up about 30 basis points over about 5 or 6 days or so, 6 sessions. You now have that 10-year yield back below 3%, makes valuation look a little bit more attractive. The VIX, though, this is so interesting. There continues to be a little bit of a disconnect between stocks and the VIX. Let's see if the VIX can go below 25. As for the future look at the S&P 500, everybody wondering whether it's a bear market rally or the start of something new. This is interesting. This is the breadth, or one way of looking at the breadth on the S&P 500. And the number of S&P 500 members above the 50-day moving average. So that's near-term momentum. Now, you can see over the last year or so, it is certainly declining. But after touching the bottom of this range, it appears as though we could actually see it go back higher. So currently, about 41% of members are above their 50-day moving average. This chart suggests that in the relatively near term, it could go closer to 60 or more. So that might make the case that the bounce that we've had over the last week or two, a bumpy bounce, but it could continue. As for Target, I'm so curious to take a look at this chart, because earlier today I was having a conversation wondering whether or not we could actually see Target go green on the day. Now, this is a 2-day chart. This is the 1-day price change. Earlier in the pre-market, Target on that bearish pre-announcement, the second one in 3 weeks, now down just 2%. Earlier it had been down 9% here, but investors taking a cooler look at this. But of course, valuation, because as this company slashes numbers, they could attract people in. The first thought that I had when I heard about this second pre-announcement slashing of the operating margins to 2%, big discounts with go to Target. What could be on sale there? And they are in fact holding the year numbers for a 6% margin later in the year, and they're holding revenue. Let's see what happens here. This story continues to evolve. One thing that's clear, though, on this year in 2022, consumer staples, think Kraft Heinz and other real staple type companies, down 5.5%. Some real outperformance there relative to consumer discretionary, down 26%. Very interesting, though. Walmart had an interesting or a similar story relative to Target. That's in the staples, Target's in the discretionary, and then there's the S&P 500. But that defensive staple sector certainly providing the defense so far this year, Guy.
Abigail, I don't think you're alone in that thought. I'm pretty certain that Alex Steele probably had that thought as well. A person who doesn't like to buy full price.
Never, ever, ever buy full price.
Yeah, exactly. So I think there's some opportunities coming up. Where do consumers stand in all of this? Well, let's figure out exactly where we're going to go, both with the consumer and with Target and the whole sector. Dreyfus and Mellon chief economist Vince Reinhart talking about the story surrounding the consumer and the risk of a recession on Bloomberg TV earlier today.
The key metric right now that tells you households aren't really that worried about recession, the saving rate is low. If people were worried about their income prospects, they wouldn't be spending so much out of their income.
Joe Feldman, Telsey Advisors Group senior retail analyst, joining us now. He has an outperform rating on Target. He's got his price target on the stock, 305 down to 200. Let's talk a little bit about what the signal is here. Is there a macro signal in what Target has announced today, or is this a Target-specific issue?
I think there is some level of macro signal here related to the discretionary side of the business. The consumer has slowed down sales on discretionary, particularly home-related goods and other outdoor-related categories that they were spending a lot on the past couple of years during the pandemic. And there's excess inventory that needs to be cleared out. However, the sales, the top line for the company is actually quite strong, and they're seeing footfall increasing at their stores. People are actually visiting more frequently. So they are buying things. They're buying consumables, essentials, and other products. They're just not buying as much discretionary goods. So I think that's probably the biggest macro signal there, that there's just been a little bit of a shift in what consumers are spending on right now.
Hey, Joe, I feel like this was the conversation when they came out with earnings 3 weeks ago. And I'm just wondering kind of what changed, what kind of clarity they got, or what did they get over the last 3 weeks that made them have this kind of pre-announcement?
Yeah, we were thinking the same thing because they just told us that exactly what they're doing is what they're doing now. It does seem that the level of markdowns that they're doing and clearance to remove the inventory that's excess at the moment is higher and more aggressive than what they had initially thought. And I think that they're seeing more pressure there. And so as a result, they basically had to slash their profit numbers by a fair amount for this second quarter. It does feel like it's going to be more isolated to the second quarter. I'm sure some will drift into the third quarter in terms of some clearance, but they are working aggressively to get into a clean inventory position for the second half of the year. And this is something we've heard from other retailers as well. If you go back to a couple of weeks when Walmart reported earnings, they basically said the same thing, and a lot of other retailers are doing the same, where they are trying to, working through some of the inventory levels to get in a better shape for the second half.
Joe, is the consumer more difficult to predict in terms of what he or she is going to be spending money on than normal?
Yeah, I think it's been a little more challenging lately because you're seeing a bifurcation in the consumer, where that lower to middle income consumer is under a lot of pressure, and we're seeing that real focus on saving money and trading down, more private label purchases for that consumer, and really a focus on essential goods, food and basic household daily needs. At the other end of it, you're still seeing that middle to upper income consumer spending at a relatively normal rate as to what they have been. Now, they have been shifting away from discretionary a little bit, but the more affluent consumer is still planning to take a lot of trips. They're shifting towards going out clothes and more party-oriented things and trying to re-engage. So you're still seeing some level of spend on discretionary at the upper end. It's just at the middle to lower where it's really been a lot of pressure.
All right, so the stock's trading right now 157. When do we know is the right time to buy Target stock, knowing that they're not going to go out of business or anything anytime soon, and they're still going to be a good staple for consumers?
Yeah, I mean, it feels like a pretty decent value today, actually, and as you guys are mentioning earlier in the previous segment, that the stock's actually bounced back quite a bit from its initial low. And I do think that investors were expecting things to get a little bit worse before they get better. We certainly were. And if anything, this may not be the end of it. There could be more revisions as the year goes on, just given the volatility with the consumer and all the macro pressures that we're dealing with. But at the same time, the stock, even at a new lower earnings per share, $8, $9 a share this year, maybe it's 13 next year, it still looks like you can get to, kind of 175, 180, somewhere in that range from where we are today.
Joe, a lot of what was planned this summer by a lot of people, and I'm talking about probably the second group that you were referencing there, was probably predetermined. They made a lot of the decisions on weddings, on vacations, etc., probably 3, 4, 5 months ago. What happens later on this year? The cost of living squeeze is coming. Stock prices are down. It is getting tougher out there. How easy is it to predict, for instance, the holiday season right now?
I think it's very challenging to predict the holiday season right now. I think, look, holiday always comes. Everybody wants to celebrate and spend some money, but it's really difficult. As you guys have been talking all morning and recently, gas prices are a killer right now for the consumer. I mean, when you go fill up your car and you see the ticket and the sticker shock on that gas fuel, it's really difficult. And it causes the consumer to really rethink what they're spending on. And I think you're right. A lot of, the summer travel and some of the weddings, things were kind of baked in 4 or 5 months ago, and it makes it for a very difficult second half. We're hopeful that inflationary pressures will ease a little bit as the year goes on, and if that is the case, that might help a little bit. Maybe oil prices, gas prices can come down a bit. Yeah. That would certainly help, but it's really going to be challenging. I think it's going to be a tough holiday right now as we sit here today.
Okay, here's what I'm doing. I'm going to buy the stuff that's going to be on sale now as they clear their inventory to then give it for Christmas gifts. I'm just saying that's the way forward. Hey, Joe, before we let you go, what other stores, if we look at what Target said today, what other companies are going to have to re-rate their profit margins to the downside, and is that fully priced yet?
Well, I think there are some, where there's more discretionary leanings. We've already heard some, like the big lots. Five Below is going to report tomorrow night. Some of the more discretionary-oriented companies that we cover, I think, are going to be challenging. I think some of the department stores I worry about. But at the same time, you have some of the core discounters, the dollar stores, the Walmarts of the world. Even Tractor Supply had a positive pre-announcement last night, where they're still seeing good outdoor sales for lawn and garden and things. And that bodes well for Home Depot and Lowe's. So there are pockets of the economy, or the retail sector, I should say, that are hanging in okay.
All right, hey, Joe, really appreciate it. A great perspective today. We appreciate you breaking down the numbers for us. Joe Feldman of Telsey Advisory Group. Coming up, consumer spending habits are definitely changing because people are actually traveling again. Those sky-high airfares are the latest headache for those globe trotters. We're going to speak to Alaska Air's CEO coming up next. This is Bloomberg.
Greatest minds.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Boris Johnson is trying to draw a line under the controversy that's been threatening his leadership, but the scale of the mutiny against the British Prime Minister suggests his days may be numbered. Johnson survived a confidence vote by members of his own Conservative Party. Still, more than 40% of Tory MPs voted against him. Johnson now says it's time to get back to helping people with the cost of living. Russia has come out with its own sanctions. It has indefinitely banned 61 U.S. officials and executives from entering the country. Amongst them, Treasury Secretary Janet Yellen and BlackRock CEO Larry Fink. Moscow says it's retaliating for what it calls constantly expanding sanctions against its citizens. And Hong Kong won't tighten coronavirus restrictions before the city's July the 1st handover anniversary. That is according to Chief Executive Carrie Lam. There's been speculation that China's President Xi Jinping might attend the celebrations. Hong Kong's COVID cases have been rising since the city began rolling back social distancing curbs. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Alaska Airlines is on a new journey, a 5-part path to net zero carbon emissions by 2040. Joining us now from the Up Summit is Bloomberg's Ed Ludlow, who is there today with the CEO of Alaska Air. Ed, over to you.
Yeah, good morning. We're in Crystal Bridges Museum, downtown Bentonville, Arkansas. We're surrounded by flying things. These are battery electric, future flying, autonomous ride-hailing technologies. You're laughing at me, but your goals are a little bit more near-term when we talk about investing in technology. You're super focused on efficiency, and last night you did this flyby. Tell me about the flyby. What was that about?
You know, it was our 737 MAX. It's our sustainability livery. It's got a beautiful orca on it, but it's our most modern airplane in our fleet.
Okay.
It's 25% more efficient than the A320s it's replacing. And we've got, I mean, the way I think about it, Ed, is, you know, we've got existing infrastructure with our existing airplanes. So we're making operational efficiencies. Sustainable aviation fuels is a big enabler for us to get to our aggressive goal of 2040 to be net zero. And, you know, being here at this conference, watching all this amazing technology, it's mind-blowing. I've been in the industry over 30 years, and watching this industry transform before my eyes, you know, knowing that there's an airplane that flew from Vermont to Bentonville, battery-powered electric airplane.
1,400 miles.
1,400. It's
well, you're also an engineer by training.
Yeah, so I love this stuff.
And I should clarify, this was a low-altitude flyby. It literally went over my head. I wasn't expecting it, which is why you're laughing at me. But ultimately, this is about the bottom line, right? You revised guidance recently for the current second quarter. Fuel was a big part of it. Explain that. Connect your revision to guidance for the need to look into more efficient fuels, invest in technology.
Well, you know, just to give you a sense, you know, an airline has a cost structure that about 60% of it is just labor and fuel. And so as we look to the future, you know, we're using hedging strategies, so about half our fuel is hedged for this year. So, I mean, we'll save $200 million with our hedge strategy. But as we look forward to the future, we need an alternative source. And I think sustainable aviation fuels can be produced. Right now, it's not affordable. I mean, that's the issue with sustainable aviation fuels. Even if it was $1 more per gallon than traditional jet fuel, and we burn $1 billion. We burn 1 billion gallons of fuel a year. That would be $1 billion. It would wipe out our entire profits. I mean, so that's the question: is how do you produce, you know, enough volume of sustainable aviation fuels and do it affordably?
Guy and Alex are chomping at the bit, but I'm sticking with tech. Okay. Artificial intelligence.
Yes.
You talk a lot about artificial intelligence.
Yeah.
Why? How does that help you?
You know, we took a bet in 2018 on 3 entrepreneurs who came in and they were doing AI and ML for self-driving vehicles, autonomous vehicles, and they thought that their software was applicable to commercial aviation. So they came to us and said, hey, you're an airline that, you know, likes innovation, and can we get exposed to what you do up in the sky? And we worked with them for 2 years, and we developed new flight plans, working with our dispatchers to fly airplanes from point A to point B using artificial intelligence and machine learning that saved us about 3 minutes of flight. In 2016 alone, on 20,000 flights, we saved 11 million gallons of fuel using AI and ML. Wow. And we just bet on 3 young guys in their 20s, and today it's a 65-person company. They're in 3 countries, and airlines are lined up ready to sign with these guys. It's just a great example of industry coming together with entrepreneurship.
Ben, it's Guy. Can I jump in and ask some questions? Because I'm fascinated what you said just a moment about SAF and the